So this is the part two video of the reaction of the Mark Douglas Mind Over Market video. If you guys haven't seen part one yet, I highly recommend going to watch part one first. I guarantee you you're gonna pick up on a few things and a few key points and gold nuggets that you guys could definitely use and benefit you in your own trading. So let's get right into it.
TV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads.
Right.
Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern.
Right.
You also talked about how
It's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information.
Right.
So, for an example, if I'm in a losing trade, and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case. Right. It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers.
That's absolutely correct. So basically what he's saying is, because of your strategy and the edge you may have, you might convince yourself to think that this trade is right and this trade has to work out. And so what he's saying is that when you do this, you give yourself expectations. And when you give yourself expectations, you're convincing yourself that this particular trade is going to work out. And when you do this, you are ignoring the information that could potentially be telling you to exit this trade, that it's not a good trade, and things like that. So when you give yourself high expectations on one single particular trade, you could be missing out on key information that's telling you, market information that's telling you that this is not the right trade to be in.
In a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right, I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to?
Well, yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't. Regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours, You bought the stock at 10. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good.
Right.
And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. That you know, my reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, you know, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you
by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot
Thinking in
machine?
a probability mindset.
Now,
I don't like it.
You know, you might, okay.
But I played it.
Whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it was a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel? Well, do you feel betrayed? Do people betrayed by the machine?
No.
Okay.
Because it's a
Why
slot
do you
machine.
not
You're
feel
not
betrayed by the
expecting to
machine?
win.
It's just a random. It's just.
Oh, it's a random outcome. Okay.
Right.
So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly. Okay, because you know the odds aren't exactly.
That's
in your
literally
favor.
how you should feel about your trading.
What
The same
trading
way.
systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not, I mean this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, you know, so for an example, well, let me backtrack a little bit and say that most traders, you know, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in the machine.
That is our loss. The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay?
Okay.
And then what we do is we wait for a pattern to show up. And if the pattern's, you know, a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. First. The pattern shows up first, okay? Then what we have to do is put up our money, meaning how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market.
You could be
like some of those errors that I.
You could be so caught up on an analysis. You could be so convinced that this trade is going to work out that you could even forget the mere possibility that you actually put risk on the table for this. You know, you become so convinced that you're going to win off of based upon this analysis that you forget that you're risking you forget that there's the possibility of you losing that $250 you put on this trade. So that's exactly what he's saying.
In the beginning,
right.
How many people put stops in the market and take them out, and then and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it. But they haven't really accepted the risk.
Right. We see that every day.
Yeah,
every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is.
It's a
In other words,
numbers
you get
game,
an edge
probability.
that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence to wins and losses. You got to be able
Like
to
flipping a coin.
identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which
Which
is another problem on itself.
Oh, yeah. But see, the thing is, it's like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
And see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think.
It's a
And
mental
how
sport.
does a trader do? I mean, what are the steps? I mean, is there obviously by reading your books, by getting themselves immersed in your thinking, is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise they can do?
Yeah, absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just it's just like anything else in our lives. When we realize that there's a particular goal that we have, and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay? And that's why there's so many people who are so close to getting it, but never really get beyond that
What's
threshold.
that hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
You have to change your mindset, bro. You have to. You have to wait. You have to change the way you're going about, your perspective on what trading is. It's the only way to win. If you conquer this up here, you'll go down a road to unlimited riches, right? Trading it's not all about technicals, right? It's a pure mental game, and you have to understand how the game is played. You have to develop your trading IQ, guys.
Changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do
got
evolve.
an hour and a half, by the way. Keep going.
We do? Oh, okay. Well, yeah. You got that long, honest to God?
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right.
On.
And that's all it is. When you put on a trade and it doesn't work, all it really means is this, is that some other traders didn't come into the market that had the same belief that you had or the same conviction that you had about this market doing whatever it is that you thought it was going to do. That's all it is.
Powerful
There's nothing
message.
more than that.
And you have to learn to walk away.
And you have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? Someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter, okay?
Exactly.
They find themselves doing things that, what am I doing this for, And so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade by trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology, at the very most fundamental level, what this is telling me,
right,
is that
fresh cross.
There's a higher there's a high, or let's say, the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means.
Right.
The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold.
That's all your
it's saying.
edge is.
Now, they're either going to come or they're not. And so, as a result, I don't look at this as being a right or wrong.
Either you're entering the market at the same time, right? You're either moving with the market or you're moving against it. You never want to be moving against the market, guys. You want to be moving with where all the big whales are buying and selling at, those key levels.
I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out. It's not worth the cost of finding out. That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DVD.
Yeah, absolutely, but not like
very
specific. Not the kind of specifics that, like if you're in a half an hour time frame, how much.
Well,
how
that's
much
the trader's decision.
Yeah.
But the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to their risk tolerance, etc.
Right.
What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can, yes, from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you were able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise?
Traders are good losers.
Yeah, absolutely. I mean, and that's what I suggest to people, all the time. Especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I mean, I was coaching some pretty substantial money managers, and they'd get into a situation where they're on a pretty good losing streak, and often it required that they actually go back to a risk level that they hadn't. Meaning that if they were trading 10,000 or 100,000 shares, or willing to take $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares.
Hey, when in doubt, decrease your risk. If you're ever on a losing streak, that is a tip that I do personally. Whenever I'm trading bad, whenever I'm not in sync with the market, right, I automatically decrease my risk. Automatically, until I start feeling that confidence again. Till I start getting streaks again, you know what I'm saying? Until I feel in sync with the market, I would decrease my risk.
And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that I mean, look at it this way: paper trading. Okay, paper. A lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when their real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology, paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology, but more so, it is a graphic representation of the mental skills that you don't have.
That's an interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills?
Look at your paper trading.
Yeah, look at your paper trading in relationship to your real trading. Now, if there's, and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss.
Right.
Because the way our minds think, in other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendencies to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader.
Right.
But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares, and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point.
You have to change what losses mean to you. There's a difference between good losses and bad losses, and I've talked about this before. You know, bad losses are you're doing things that you're not supposed to be doing. You're not being patient. You might have oversized on the position. You might have took a trade that you're 50-50 trade that you're not necessarily confident in, something outside your plan. And then there's good losses where you're doing everything you're supposed to do and it just simply didn't work out. The probabilities were not in your favor.
That is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as almost your goal, if you will. Almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. That's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at WiseFest and earlier we talked about some events of pain in your life. And a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change?
Yeah, I mean the answer is yes, bro. I didn't make the changes necessary to start journaling, to really be disciplined, like really, really be disciplined. I'm talking like not break a rule ever, you know. I didn't make that change until I just kept blowing accounts, kept losing money until, I just had to keep losing until I finally realized, like, hey man, something's got to change. Something has got to change. And I feel like a lot of you guys aren't gonna listen to what people, the advice that people tell you. You know, you're gonna have to learn the hard way. And I had to learn the hard way too. So, you know what I'm saying? It's just gonna hurt a little bit. And a lot of you guys aren't gonna be able to have the mental framework and the mental toughness to get over those losses and to actually overcome yourself. I made a video on why you never be a successful trader. Go check that out because you're constantly stepping in your own way.
And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication, actually? And I'm not trying to be rhetorical here. I really want a serious answer because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You aren't in pain right now, are you, Jared?
What's that? Yeah. I'm good. I've been out in the market all
I'm
week.
just kidding. Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring
Well,
to?
explain
Like, everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You
You
don't
trade
think
them
about
without
it. There's
fear,
nothing
without
to think about.
hesitation.
It's like don't think. There's nothing to think about.
And you trade within your means.
Except the risk.
When
and
you
how you're
see
gonna
your
take profits.
setup,
But I'm saying the pattern
execute.
itself. When the pattern presents itself,
no
there's
point.
absolutely nothing to think about.
That is the
because there's no
objective
way
part
There's
about
nothing
you
to
can
think
know. Yes,
about.
there's
There's
no
no way
you
to
can
know
what the outcome's going to be.
if there's going to be a winner or loss.
Mark, we do have another hour.
All right, so guys, this is the end of the interview. I really hope you guys paid attention. I really hope you guys learned something from this video, guys. If you guys learned something, please drop it in the comments. Your most valuable lesson from this video. This is by far one of my favorite psychology videos of all time by the great Mark Douglas. Guys, please like, comment, and subscribe, and I'll see you in the next one.
762, man, we blasting his whip. Whole lot of blood had to down me a crib. He say he can't breathe cause he tagging his ribs. Caught him outside with